If you've been following the bond market lately, a major theme is taking shape, and no, it's not just the tariff. It's the rapid rise in government borrowing and ballooning debt levels of governments right around the world. That growing concern is beginning to put upward pressure on bond yields. So what does that mean for fixed income markets and for investors? Joining us now, Hafiz Noordin, Vice President and Director, Active Fixed Income at TD Asset Management. Nice to have you here.
It's great to be back.
Okay, so government borrowing, we've heard, this is all a bit of the Trump effect. He comes out, he tells governments you need to spend more on defense. They go, okay, and then they have to borrow to spend. Why is it taking center stage now? Because we've been talking about it for a little while.
Yeah, and it felt like we got used to government borrowing for a very long time, since the global financial crisis, since the pandemic. They've always had to step in to borrow to help support the economy. The reason it matters a lot more now is that central banks are not playing the same role they used to be of buying bonds on the other side of the equation, right? So the governments issue bonds to supply all of these borrowing needs. In 2008, 2020, we had central banks doing quantitative easing to buy those bonds.
And the reason they would buy the bonds, just to make it really basic, is they're injecting some money in the economy, right? They take the bonds off the market, put the cash in. That's right.
And it was okay then because inflation was low.
Right.
Central banks can't do that anymore because inflation's stuck, like kind of sticky above 2%. Mm-hmm. So if they do that same kind of strategy, inflation's going to go up, right? So we know they can't step in. So who has to step in to buy these bonds of governments that are issuing? It's private investors, it's banks, households, insurance companies, and they're more price sensitive, right? So they're demanding a higher yield for owning these bonds and lending to governments for 10, 20, 30 years.
Right. So just I'm saying this back to you. So by not having one of the biggest buyers in the market back out or stay on the sidelines, you're seeing the yields start to move up because they're not in there.
That's right, yeah, and particularly at the long end of the yield curve. So if you look at 10-year and 30-year yields, the 30-year yields in particular have been the ones that have been moving higher, reflecting that dynamic.
Can you tell us a bit, this is kind of bonds 101 for a lot of us, which is, I think, in need. You say that the US and Europe and Japan are some of the regions really driving this trend. Is that because they're borrowing more? Are they more sensitive for different reasons?
Well, certainly the size, right? So U.S. in particular, we can start with the U.S. because, $30 trillion economy. Mm-hmm. We saw that the Trump administration passed the One Big Beautiful Bill. And so when their Congressional Budget Office, who does all of the projection work around debt levels, when they do the math, they project that over the next kind of 30 years, their debt to GDP is going to go from 100% to 160%.
Which is mind-boggling.
So when you do the math, that's about just over the next, say, 10 years, that's $6 trillion of new debt at the government level. And so that has to find a home. Europe, similar kind of idea. Germany made news earlier this year releasing its debt brake that was normally this kind of fiscal limit. So they're planning to issue, call it about $1 trillion over the next 10 years. Japan already had debt to GDP levels of about 230%, and they're still running bad deficits. So those big economies matter a lot because when they're all borrowing at the same time, then global bond markets in general get impacted, and it really becomes an issue across a lot of different economies.
Bond investors, I get lots of choice. We'll come back to that in a second in terms of maybe how they do that choice. But for the longest time, the reason, that bonds are in portfolios often is it's an anchor and it keeps people safe when things are volatile. Are investors starting to, and I feel like I ask this all the time for 10 years, is now the time that we're starting to pull this in question, but are they starting to question that assumption, though, that maybe because of the size of the borrowing, maybe it's not as safe anymore?
Yeah, so I think from one perspective, governments are still safe in that you look at credit ratings, right? The high-quality governments like Canada, like Germany, still have their AAA credit ratings. So there isn't necessarily this big worry about default risk, right? That these governments will default on these bonds. But there's certainly a repricing of how much do you want to get compensated as an investor for lending to a government, especially for long-dated terms like 30 years, right? So it's just in that old era of when central banks were buying these bonds, it was skewing the pricing of what you should be getting for lending money for that long. And so I think it's more of this recalibration, so to speak, of what's a fair price for this level of borrowing that governments are kind of going through.
And what's happening at the long end? You're saying, I'm sure the short end is, it's a little more I don't know if liquid's the right word, you tell me, but things are moving. But in the long end, you're taking risk for a long time in a weird situation right now with government. So what's happening there?
Yeah, so, and it's good you kind of pointed out the short end, because the short end of the yield curve, 2-year yields, have actually been coming down this year because central banks are cutting rates. And so central banks can really kind of influence materially the short end of the yield curve, but they can't influence the 30-year part of the curve. And that's the part of the yield curve that's reflecting all of these fiscal dynamics. And so when you look at the US 30-year yields, they're up 25 basis points this year, even though their 2-year yields are down. Germany up 65 basis points. Japan's been the worst. Their 30-year yield is up 90 basis points. When you put that in return numbers, if you were holding a 30-year Japan government bond on January 1st, today your return on that is negative 15%.
Wow.
So these are big moves that matter. And yeah, so they really do shift kind of the thinking around the risk return for long-dated government bonds.
How's Canada looking in this landscape? Are we attractive? Are we less attractive? Or what's happening?
Yeah, so I would say purely from a fiscal perspective, when you put the federal and provincial balance sheets together, the debt to GDP level is about 100%. It's not great, but it's not kind of the worst.
It's not over 200 like Japan.
It's not over 200, so we're thankful for that. But I think where there's more of a favorable outlook for Canada, it's the deficits, which are only about 0 to 1% of GDP right now. Compare that to the US, which is at about 6% of GDP in terms of their deficit. So there's, generally speaking, you could say there's more room for the federal government in particular to be able to borrow to fund some of the things they've been talking about. The same kind of themes are here: defense, infrastructure. But I think, we know that the government's going to be borrowing more. We don't have all the details. We'll hopefully in the fall have a budget. Once that does come out, then I think there'll be more scrutiny again around how are they going to fund all of these new initiatives. And so in the meantime, though, the 30-year Canadian bond yield has been going up as well, about 55 basis points
Anticipation of what's happening?
That's right. Markets are forward-looking. We know that where the direction is, even though we don't have all of the details. So yeah, Canada's not really immune from this theme either.
We've been talking about government debt and government bonds and a whole lot of supply, not as much demand, and that's what we're seeing play out in the market. Talk to me a bit about corporate bonds and maybe does what I said make the case stronger for corporate bonds, or what are you seeing in the corporate bond market?
Yeah, well, so in contrast to high and increasing debt levels in governments, the average kind of corporate bond or corporate issuer, especially investment-grade corporate issuers, have been really strong in terms of fundamentals. Their debt levels have actually been going down over the last few years, and their earnings have stayed stable. And so they've been prudent in terms of managing their balance sheets.
And when you say debt's been going in, they've just been trying to retire debt because they didn't want to pay high rates? Is that...
Yeah, in some cases they're outright retiring debt, or they're just not issuing as much new debt. And they had a period in 2020 and 2021 when yields were very, very low, with slow, because the economy was slow and we had all this quantitative easing, so they were issuing out and terming out a lot of their debt.
Right.
So they're reaping the benefits of that, today and even for the next few years. So and then at the same time, what we're seeing is that because yields are high right now, investors that are already invested in corporate bonds, when they get a coupon, they are generally reinvesting that back into the market. And so when you look at the amount of coupon income that investors are getting, it's almost in line with the amount of new borrowing needs that corporates have. So there's a very good supply and demand balance, unlike what we're talking about for governments. And so I think that's really strengthened the case for corporates. It's not just the fundamental story of balance sheets and earnings. It's this, what we call technical or supply and demand balance that is very sound right now. That keeps corporate, the case for corporate bonds pretty favorable going forward.
How's the Canadian corporate bond market looking?
Yeah, well, I think when all of those kind of arguments hold true. Credit quality is very strong in the investment grade part of the corporate bond market here in Canada. And when you look at valuations, if you let's say you look at a typical term for corporate bonds, about 5 years, and a 5-year corporate bond on average gives you about a 4% yield. If you wanted to get a 4% yield lending to the federal government in Canada, you'd have to go out to the 30-year term. And as we talked about, you have to you'd be faced with more volatility.
Yeah.
So you're getting attractive level of income only lending for a 5-year term to a very high-rated, single A or triple B rated corporate bond issuer. And when we think of the stability of bond yields at the short end of the curve, the Bank of Canada, has cut rates and, is kind of expected to be on hold or maybe one more cut. And so it's all of that stuff around the fiscal issues won't be impacting the 5-year part of the yield curve as much. So that 4% yield you're getting should be pretty stable going forward. And I would say even in a scenario where you get a recession and where credit spreads tend to go up, at the same time, you'll probably get the Bank of Canada cutting, right? So that yield will kind of, when you net those two forces out, 4% still probably a reasonable scenario, even in a recession type environment.
What about the U.S. market? Because I think, and you probably get this question a lot, when people are looking at U.S. Corporate yields, they're higher. So why wouldn't I do that?
Right, yeah. And so, when you look at a similar, investment grade corporate bond in the U.S., at a headline level, it's about 5%. But the trick is that when you're holding a U.S. bond, you have to take the currency exposure. So you either have to be willing to keep that U.S. dollar exposure, and then you're subject to the movements in the U.S. dollar versus the Canadian dollar, or you can hedge that U.S. dollar exposure back to Canadian dollar. And hedging costs right now have gotten pretty high, right? So that 5% after hedging costs goes down to 3.5% yield. So that's actually lower than a 4% yield on a Canadian corporate bond. So really, when you do the math after hedging for those risks, you're better off in a Canadian corporate bond.
And I'm not putting words in your mouth. This is but from most folks I've talked to, that people feel the trajectory of the U.S. dollar is down from here, and that's just something when you talk about the risk of holding the U.S. dollar in the longer term, that's something that you have to be comfortable with. Right, and
you can either say I want this to be a lever where I'm actively managing my portfolio, but for many investors that's not a risk that they want to take, and there's a lot of arguments right now of why the U.S. dollar could be in a long-term bear market. It's still, I think, wait and see on that, but I think the story around capital reallocation out of the U.S., where there's been so much capital inflow over the last few decades. At a minimum, there's been sort of a reassessment of, are there opportunities outside the U.S. in Europe, Canada? And so I think there's some really important questions on, whether if you're going to take currency exposure and keep it unhedged, is that prudent in the long run? And so that is something you should at least be asking yourself when looking at U.S. or even other markets.
I've only got a minute left. I'm going to try and squeeze a couple things in, but I just want to talk about emerging markets a bit, but also just, you talked about active management. I mean, that is something that I know you all do, is just because this is a volatile market. There's a lot going on.
Right, yeah, and so, emerging markets are another sort of area where, there's been a lot of opportunity. They've done very well this year, and a lot of that has been part of this U.S. dollar coming down. But I think when we think of opportunities going forward, it's not necessarily a clean story that the U.S. dollar will continue to go down in a sort of orderly way.
Yes. And
emerging markets, whether they're bonds or equities, will give you those same kind of returns you've got in the first half of 2025. So I think some of that those easy returns are behind us, and from this point out, there has to be a little bit more of an active management lens. Whether it's on U.S. corporate bonds versus Canadian corporate bonds or emerging markets. And so I think really it's volatility does present opportunities, but you have to be prudent in understanding your risks and hedging where you feel that makes sense.